Welcome to This Week in Money. I'm Jim Goddard. Today, CIBC Wood Gundy's Ross Clark has ideas on how to exploit falling oil prices. Real estate consultant Ross Kay comments on whether it's fact or myth that Chinese millionaires are driving the Vancouver real estate market. And Tim Cyclesman Wood comments on where the price of oil might go according to historical and technical charts. We talk to Ross Clark right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600. Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark, investment advisor at CIBC Wood Gundy in Vancouver. Welcome back to This Week in Money, Ross.
Well, always a pleasure to be back with you, Jim.
What is happening with the markets? I understand this has been one of the most volatile weeks in the past year.
Well, actually, it probably goes up even higher than that as far as the measurements are concerned. The first 5-day stretch that we had, sort of from the tail end of last year and through this year, the worst 5-day stretch at the beginning of a year since back in 1925. So that was into Tuesday, and then we had two fabulous days on Wednesday, Thursday, and gave back some here on Friday. So, but the percentage moves are, fairly big. You're getting, all of a sudden now we're getting these 1% and 2% ranges back-to-back days. Got a lot of divergence, like we saw in the early part of December as well, where you're having a large percentage of stocks, like over 2.5-3% of the stocks, making two 52-week highs, and on the same day you've got a large percentage making 52-week lows. So we've got this total discrepancy, and that's in the U.S. market. Unlike the Canadian, which was even worse in terms of the disparity, because here our resource-based stocks clearly put an extra bias to the numbers there. So this means there's a lot of then sector rotation happening, and I think that's what the investors have to be looking forward to as we pass through this year. They clearly go with where the money is flowing to rather than away from, and this is a year for caution.
Now, when you say a year for caution, is it any particular kind of investment, or is it everything? Well,
I think we've seen some real extremes happen here. Look at the move we've had in the U.S. dollar, the Canadian dollar. We've got 17% move in the U.S. dollar index since the spring on the upside. It's clearly now into the target range I had, 92 to 94. The Canadian dollar made it down to the 84.60 target area. So, I wouldn't be at all surprised to see some reversals here in the near term. Other things, the oil market just continues to search for a low. And one piece of research we came up with in the last week here, looking at it, as the oil market breaks and it gets well into one of these waterfall type of declines, such as we're seeing now, and we've got half a dozen of those in the last 30 years, the gold and silver markets, the bullion, do very well in the 2 to 3 months that actually precede the low in the oil market. So what we're seeing right now is what we see when we go back in history, in that, we've got gold this year, it's up, just over 3% on the year. Silver's up about 4.5%. The miners, the GDX, and the Canadian XGD are up 12 and 13% in the midst of, an equity market that's thrashing around. So this fits part and parcel with, I say, the movement down in oil. What you want to be watching for is that once oil finally starts to stabilize and base out and go through that classic 2 to 3 months of consolidation at its bottom, that will probably become the cap for the silver and gold. So a little bit of forward advice for people in terms of, that will be your time if you've stepped into the metals here to take some money off the table.
What about investing in the oil sector with shares coming down along with the prices?
Well, the shares, most of the highly levered oils and gas stocks are continuing to erode down with the oil price and with the natural gas price. But in the companies that have got less leverage, what we're seeing is that the initial lows that happened in the middle of December, that we got that really good bounce off the bottom. And technically, I look at it, we got back to the 20 and 50-day moving averages, which was a natural place to have resistance. And most of those premium stocks that I would say, giving them a little label here, they're only giving back right now maybe 40 or 50% of the gain that they made off that first low. So, and this is as the oil market is moving down. This is very similar to what we saw in 2008 as oil was breaking down through the $40 level, and the major oil stocks, they started to bottom out well before the oil price itself. So what you need to be looking for is a stabilization in the oils, and typically that would be the month of January. The latter part of January is usually when you want to buy oil stocks. And the way they're setting up right now, that could very well be the game for this year. I'll tell you, this oil and gold chart that I've got, I've had a couple of people in the office, clients, and we've looked it over, and their eyes just pop wide open like, wow, yeah. We're there for a good time right now on the precious metals and the miners, but it's not going to be a long time. I think it's probably, if we're lucky, it's got another month and a half left in it.
Thanks a lot, Ross, for being here on This Week in Money. My guest has been Ross Clark, investment advisor at CIBC Wood Gundy in Vancouver. If you have any questions for Ross, you can email him at ross.clark@cibc.ca. Coming up, Ross K. on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Ross K., president of Ross K. Realty Consultants. He's a former realtor who's now a real estate consultant. Welcome to This Week in Money, Ross.
And thanks for having me.
Question number one, with the assessments just coming in now for British Columbia, are there any winners or losers out there in the real estate market?
Well, there's going to be winners and losers when it comes to paying property tax in 2015 and 2016 as these new assessments roll out. If you're looking at the assessments coming out in BC, Alberta, across the country, the stratification of housing prices over the last 5 years is now starting to impact your property taxes. So what that means is that if you owned a detached home, your property taxes as a percentage of what you're currently paying are going to increase, while if you own a condominium or a lower priced home, your property taxes will actually decrease in the coming years. And that is something that no municipal government anywhere in Canada has addressed.
Every year they talk about hiking your property taxes. They say, well, just the rate of inflation if they're a place like Burnaby, which manages to do that year after year. But most cities like Vancouver, it seems to me they assess your property another 8 or 9%.
Yeah, well, your house is going to be the actual tax base. So whatever the municipal government decides they need to run their municipality, they establish that. So let's say they establish it at $1 million. Now, if there's 10 houses in that municipality and they're all worth $100,000, each property would have to pay $100,000 in taxes. But that's not how the prices are set up. You'll have some houses that are worth $50,000. You'll have some houses that are worth $200,000. You'll have other houses that are worth $500,000. That $500,000 house then shares one half of the tax base. So even though they say that we're only going to increase our taxes by inflation, which is true, I mean, they're not lying when they say that. What they're not adding to the statement is, but if your house value has increased higher than the average for our community, you're actually going to now be responsible for paying a higher share of the taxes for the municipality, irregardless that you are using no extra services from the municipality.
Now, taking a look at markets where they've been busy and where you might have a better chance of selling your home, anywhere stick out in your mind?
Well, I think that the big change that we saw in December was when Greater Vancouver Real Estate Board just reported their sales for December, and they missed our target. So we established a target for each real estate board or large CMA. And that target is, if the market is continuing on its current path, it should be reporting that number of sales. This number is 100% accurate. It has been 100% accurate since 1982. There's a structural reason why this number is always correct. So when Vancouver missed their number by 239 units, I think they reported 2,115 for the month of December. What that means is that Vancouver is cooling quicker than we had predicted that previous sales had indicated. So Vancouver has moved into a period of contraction quicker than we were expecting it to. We had expected Vancouver to be the last market in Canada to move into contraction. It was supposed to do that in January, but it appears to have done that in December. Alberta moved in as Calgary, as we had already predicted. They reported a negative December 2014 versus December 2013. Again, we're the only people in Canada to have forecasted that. And Toronto, their numbers are almost basically the same as what they were the previous month. But there's a little bit different with that discussion, and it requires a little bit higher level of discussion, which is probably not suited for the radio. All I can tell you is the entire GTA has also entered a contraction as well here in Ontario. What
about the Okanagan? Has it stood out at all?
Yeah, well, it stood out to me because knowing that we were going to talk today, I looked at the sales data for the Okanagan last year. And you can see what the difference is when you don't have too many realtors in a marketplace. So the Okanagan Mainland Real Estate Board, their agents are turning over about 16 transactions per agent a year. So that means every realtor on that real estate board is handling 16 buyers or sellers over the course of the year. Versus the Canadian average, that's double. So those realtors have twice the experience in a single calendar year than the averages across Canada. When you look at the stability of the Okanagan market in the last couple of months compared to Calgary or Vancouver, where the craziness had been ongoing, the Okanagan homeowners should be a little bit happier because clearly their agent population in that area has been acting in a far more responsible way in how they've dealt with the consumer. So those people are way, way, way further behind in their risk assessment than Vancouver, Calgary, or Toronto homeowners would be.
Right now in Vancouver, there's the belief that real estate prices won't fall for one reason, at least in the pricier areas, because we have all these millionaires from Hong Kong and mainland China moving to the lower mainland. Is that actually happening?
No, it's not. And I think we had an earlier interview. You interviewed me earlier this year, and we had discussed this. So after that meeting, I was in contact with the Bank of Canada. And right now, the Bank of Canada is investigating whether what I said was true or not. And that is simply that they can collect FINTRAC forms for every transaction that's done in Vancouver. Those forms have been collected with 100% accuracy since 2007. So all of the myth that is out there about foreign buyers driving the market in Vancouver can quickly be dispelled the moment they the government asks for those FINTRAC forms to be handed in. Now, those FINTRAC forms are in every single realtor's office in British Columbia, in Vancouver. They're in every lawyer's office in Vancouver. They're in probably pretty much every bank in Vancouver. because anytime a check for $10,000 changes hands in Canada, which is generally every deposit that's laid down on a house in Canada today exceeds that $10,000 deposit, there is a complete vesting of the individual that has to be done. You have to see their driver's license. You have to verify where they live. If they're at a foreign, like new people to Canada, you got to see their passports. There is no way of hiding those details. If a realtor was to make a mistake on one of those forms, they could end up in jail. So that's how serious the collection process for a FINTRAC form is. Real estate really has not, the Canadian Real Estate Association has really not supported their own members by explaining to Canadians why the amount of money and the risk that the realtors have assumed over the last few years collecting these FINTRAC forms. Because every time one is done, the realtor could go to jail. Now they never have. That's because the government hasn't collected the forms. But the law is, if you complete a FINTRAC form improperly or negligently, the ultimate penalty is jail time. So the Bank of Canada right now responded to me in a written letter that they have a team of investigators, I'm going to use that in parentheses, following my recommendation to see how they can use those FINTRAC forms. So this myth, which my firm knows has been a myth that's been in the marketplace for over 30 years, really doesn't exist. Foreign buyers in the most dominant conditions only represent under 3% of the sales that take place. And anybody who is in the marketplace or lives in a street certainly knows that over for the number of houses that have sold in their neighborhood, that there are not more than the very odd buyer that may be from out of town, or excuse me, from out of country. That point is irrefutable.
Where are people coming from to buy real estate in Greater Vancouver or the Okanagan?
They're right there. They're right there. They've been coming out of first-time buyers. What people don't understand, what economists don't understand, what the Bank of Canada doesn't understand, what CMHC doesn't understand, but my 89-year-old great uncle understands, is that sales are a naturally evolving issue. So there's something that in the real estate business, old timers used to call the sales chain. And it was often referred to, and this is how you make money as a real estate agent. You get a first-time buyer, you sell them a house. That house that they buy, those people then go out and buy another house. When they buy, the people go out and buy another house. And that's what's called the sales chain. The sales chain in Canada has averaged about 4.8 sales. So for every first-time buyer that enters the market over the last 25 years, there have been about 4.8 sales that have taken place in the sales chain. So when you see earlier this year, the Mortgage Brokers Association, CAMP, they came out with a report where someone made a bizarre statement that 49% of all sales in Canada were first-time buyers this year. Now, to put that in perspective, they were saying over 210,000 of the 480,000 sales that have taken place in Canada this year were first-time buyers. That is impossible. That would mean that each first-time buyer sale only resulted in one further sale down the sales chain. That is impossible. There is no way for a $2 million home to sale to take place unless there was 2 or 3 previous sales in the sales chain that allowed that to happen. Because people don't own 2 houses in Canada. They only own one, unless you're going to have a rental, of course. So this goes back to the issue of the foreign buyer myth and where all the buyers coming from. It's just a natural evolution. It's always been that way. The first-time buyer enters the market. He buys the condo. The person living in that condo moves out and buys a townhouse. The person in the townhouse moves out and buys a semi. The person in the semi moves out and buys a detached home, starter detached. The person in the starter detached moves out and buys an executive level home. The person in the executive level home moves out and buys a mature level home. And then at the very end, when you're ready to move into the nursing home, you sell your home and you don't buy another one. and those are what's called divestitures. So acquisitions have to exceed divestitures in order for the housing market to grow, like for the housing stock of the nation to grow. And that's why the housing stock in Canada has only increased 1.2% this year, and why during the 1990s it was growing at a rate of over 2% a year. For some reason, CMHC, the Bank of Canada, housing economists, the banks themselves, you can go Google it right now. You can't find what I just told you anywhere. That's because they are not aware of the impact of the sales chain on the resale housing market. What I can tell you with 100% certainty is that it is impossible that that 210 of the 480,000 sales this year were first-time buyers. It is impossible that the market is being driven by foreign investors. Anybody who understands how a market evolves, they would know that.
Ross, you say for the consumer, for the home buyer or seller, using a real estate advisor can save you a whole lot more money than using a real estate agent. Maybe explain that.
Yeah, so the negativity that I've learned about the industry in the last 3 years since I was first confronted the Canadian Real Estate Association about misleading the public on the real estate data they release monthly, which they're going to release again here on the 15th. We've gone back and deconstructed the real estate process. So if you look at real estate today, if you look at Realtor.ca all year, you would find that 62% of all the homes that you saw on Realtor.ca in 2014, which people were arguing was one of the busiest markets in history, a topic we can have on another day because that's not true either. But in the busiest market, they said in history, 62% of all the houses that you saw never sold. They didn't sell, and they were removed from the market. So what the greatest fear of organized real estate has always been, which is why certain measures that they have, like new listings to sales ratio, months of inventory, average sale price. I was involved at the Canadian Real Estate Association, as was my family, when those measures were first formed. We know the reason behind those. The reason behind those was we didn't want to talk about failures. We're in sales. We only want to talk about success. Well, in Canada, even in this market we've been in this year, only 38% of all sellers were successful on their original listing terms. Only 38%. So what that means is historically, this year, just in 2014 alone, a market they argue was busy, the people that sold paid the real estate fees of the people who didn't sell. So when you see an ad run in a newspaper and you wonder, wow, that must have cost a realtor a fortune. Well, it didn't cost the realtor a fortune. It cost the person who actually sold their house a fortune. We did an analysis this year when we were getting some pushback from the Canadian Real Estate Association. In other words, they're refusing to tell the public the truth. So we went ahead and did an assessment of how much of every $10,000 in commission dollars actually goes to selling your house. So in other words, I have a beautiful home. I've taken care of it for 25 years. I've upgraded it as necessary. I was asked what price I wanted to put on my home. I had 3 evaluations done. I didn't ask over too much for the house. I asked market value. I put my house on the street for sale, and it sold in 2 days. $10,000 in commission I was charged. How much money was actually spent on my house? Well, it was only $567. So on average this year, of every $10,000 collected in commission, only $567 went to marketing your home. That's it. But where did the rest of the money go? People say that's, what are you talking about, Ross? That doesn't even make sense. The realtors have all these expenses. That's right. They have all these expenses because they force the successful sellers to pay for the failed sellers. Failed sellers don't pay a nickel. Those 62% of the houses on Realtor.ca that never sold, those people didn't pay a nickel. They used the money paid by the successful 38% to have their house on the market. The successful 38%, They pay for the MLS system. They pay for the ads that appear in the newspaper. They pay for the real estate agent's fees and registrations. They pay for the real estate brokerage's overhead. They pay the franchise fees of the franchise brands like Remax and Royal LePage, which is basically a big pyramid scheme. If you sit back and you look at the numbers, it's obvious. The successful seller pays for all of those things. And that's why there was only $567 available to market their home. So what an advisor does is that they eliminate what a real estate agent does in the transaction. So most people are not aware that there are certain rules and regulations in place where a licensed real estate agent can't tell you the truth about a property. So let's say that you're interested in buying a home, and that home is listed with ABC Realty. ABC Realty was told by the owners of that house that the basement leaked, the hydro system is no good, but they've all repaired it, and they don't want you to tell anybody that. Now, that homeowner technically is going to assume those liabilities if there's a problem in the future. And I have no problem with that. The problem I have is the realtor, if they receive instructions from the homeowner that you are not to be told those items, the realtor legally cannot tell you that. So that's something the consumer is not aware of. The consumer is not aware of in these multiple bidding situations we've heard about this year in the GTA and in Vancouver area, that when the offer comes in, certain agents are legally obligated to know the terms of the other agent's offers, while other agents are not. These are all how the inner working of the real estate industry has to operate. There is provincial legislation in each province which limits the ability of the realtor to work exclusively to the benefit of their buyer. The buyers are never told that that's the case. So why not just limit the realtor to what the realtor is good at? Now, when you deconstruct the real estate process, if you do a survey of 110,000 realtors in Canada and you ask those 110 realtors, how many of them have gone to university or college to learn about marketing and advertising, you're going to find it's less than 1%, and it's probably less than 0.1%. Have taken one university level course or college level course for marketing and advertising. Yet you're going to pay them $10,000 to market your property. Ask any real estate agent how many negotiation training courses that they've taken. In other words, what psychological training have you gained that gives me an advantage when I'm trying to negotiate a lower price on a house or a higher price if I'm a seller? Zero training has taken place. There is no training in the industry. I was in it for 30 years. I can assure you there is not a sales trainer in the nation who offers that training to realtors. You're having the single biggest financial decision of your life handed over with a contract written by a realtor that has never looked at a lawyer until it's already signed and concluded. That is bizarre. Shouldn't a lawyer look at your offer before it's ever handed over to a seller if you're a buyer? Shouldn't a lawyer review that offer? After all, in Canada, it's a $400,000 investment you're making. I'm sure you wouldn't buy $400,000 worth of stocks or a $400,000 business without your lawyer looking over the paperwork. But across Canada, that's the way real estate's bought and sold. Everybody trusts the system. Well, the system works, but the system is flawed. So if you deconstruct the business, let's say if I had $10,000 to market my property, what kind of a company could I hire to do a full advertising campaign on my property for $10,000? You would have the single best marketing campaign for any property in Canada. If you said, okay, instead of having to pay my realtor $10,000 to do the offer, why don't I pay my lawyer $200 to look at the offer first to make sure that I'm not screwing up? Well, I think everybody would realize that was probably the best $200 you've ever spent. If I'm going to buy a house, why shouldn't I get a home inspection done before I put an offer in on the property? And people are going to say, well, you can't do that. The market's too busy. They won't accept those conditions. Well, guess what? If the market's that busy, I guess I shouldn't be buying a house. Or if I do buy a house, someone should have warned me in advance with the risks that I'm taking. Realtors cannot legally do that. Realtors are prevented from stepping outside a very, very limited field of expertise. And that field of expertise is very, very finite. How finite is it? Well, in my personal opinion is knowing the makeup of the realtor population in Canada, in all fairness, it should be basically handing the paperwork over, and that's it. So you should have a professional marketing company market your home. You should have appraisers evaluate your home. You should have lawyers write your offer. And you should have a professional negotiator negotiate your price for you. That's who you should be hiring. And if you only have to pay 38% instead of the 62%, the extra 62% for those failed sales, your real estate fees can be reduced by that much. We did a survey, and we took someone who had bought a home in 1950, average Canadian home in 1950. They moved every 10 years, and they're retiring now. So that average home in Canada was worth $12,000 in 1950, and it's worth $406,000 today. The exact same home. Okay, that's what it's worth. Most people would say, hey, moving every 10 years really worked out for us. We're now worth $400,000. What they don't understand is that over the course of all those moves, because real estate commissions are almost universally always included in a mortgage, those real estate fees are amortized over the length of the mortgage. Since they're the last expense added to the mortgage, they are also the last thing to be paid off. So in actuality, the very last mortgage payment you make is covering your real estate fees that started back in 1950. When you look at the average commission rate that has been charged on each of those 10 years, at the average price that home sold for at every 10 years between 1950 and today, you would have paid $107,000 in real estate commissions. $107,000. That's what you would have had to have made in mortgage payments to pay off those real estate fees. So instead of having $406,000 at the end, of that $406,000, $107,000 you paid for real estate fees. So over 25% of the equity after owning a house from 1950 till the day you retire went to real estate fees. That is just bizarre. So if you eliminate the failures, if you hire professionals, you don't have to charge as much to the consumer. And what a realty advisor does is they step outside the realtor profession. So they give up their real estate license. They're no longer limited in what they can do for you. And the realty advisor will hire the marketing consultants. They will hire the appraisals. They will hire the lawyer. And they will even hire a realtor. But instead of the realtor getting $20,000 or $30,000, the realtor is only paid $1,500. And there are thousands upon thousands of realtors across Canada, anywhere in Canada, who will gladly accept $1,500 for handing over some paperwork. So that's what a realty advisor can do. Well, we're test marketing right now in 3 markets in Southern Ontario. The realtor professionals are totally unprepared for what's coming their way because for the first time in Canada, all of these hidden facts about real estate, like the 62% failure rate. Let me put it to you this way. A reporter in Toronto, when I talked to them about this, it was a reporter for one of the big newspapers. She challenged me about the failure rate of the 416, the outskirts of Toronto versus downtown Toronto. She was led to believe that the 62% it was impossible in downtown Toronto. It might have been possible in the outskirts, but not in downtown Toronto. Well, you know something? In this crazy market that we've been in, 51% of all houses that were listed in downtown Toronto in 2014 didn't sell. So those real estate fees were inflated by 100% to support those failed sales in downtown Toronto, which was arguably the busiest real estate market in Canada this year.
Ross, the International Monetary Fund has weighed in on Canadian real estate prices. The Bank of Canada has said our prices or our homes are overassessed by 10 to 30%. Are those accurate figures?
They're accurate figures, but they're calculating it in the wrong way. So if you look at the IMF, they're using a international calculation. So they're assuming that houses in Toronto are under the same price pressures that houses in France or England or Germany or Switzerland are under. And that simply is untrue. Canada is unique in the world in terms of how our housing infrastructure is built. You can't use rent to selling price ratios to determine that Canadian homes are overpriced. That may work in France or in England or in Switzerland, but it doesn't work in Canada. Never has, never will. We have tight rent controls. We have limited housing stock that's available for rent. As a matter of fact, most people are not aware is that the rental housing stock has basically remained the same for about the last 20 years. I think 20 years ago we had about 3.6 million rentals, and we have about 3.8 available today. So the calculations the IMF is using simply don't hold up in Canada. That doesn't mean that their prediction for our price over evaluation is wrong. It just means the way that they're calculating it is wrong. Bank of Canada. Well, why did the Bank of Canada take until November to tell people that their houses were possibly 30% overpriced? If the Bank of Canada had a single calculation in its repertoire where it believed housing prices are worth 30%, they certainly were worth 30% less in October. They certainly were worth 30% less in September. They certainly were worth 29% less in the summer. They certainly were 25% less in the spring of 2014. And they certainly were 20% overvalued throughout 2013. Why did the Bank of Canada not once during that whole period tell Canadians that the housing market was overvalued? Why did they wait until November? I know why they waited till November, because our housing statistics have now been online now for 6 months. And the way that we measure a market is now become public knowledge. So the Bank of Canada simply realized that they've been caught flat-footed on this issue. They should have come clean on this issue 2-3 years ago. They should have mandated changes at CMHC to ensure that Canadian taxpayers weren't having added risk applied through CMHC policies. But the Bank of Canada didn't do that. Now, in all fairness to the Bank of Canada, I think they're simply ignorant to the fact of housing prices, and I don't think that they were aware that the house price that they're looking at was actually the average selling price of the Canadian Real Estate Association. Because both CMHC and the Bank of Canada, when I've had discussions with them, they couldn't understand what my concerns were initially. Initially, they couldn't understand what my concerns were, that they were relying on the Canadian Real Estate Association average selling price. I think in the meantime, with the Home Value Index being live, and with some information that I've supplied to certain departments in their organizations, I believe that they've done some research here. They've realized they've been caught flat-footed. And what I really wonder is, they came out with that pronouncement in November. What kind of liability has the Bank of Canada assumed? Like, I really wonder that. You can't just come out with 1 month and say all of a sudden prices are overpriced by 30%. And because if you did, why didn't you tell Canadians for the last 2 or 3 years what the problem was? Shouldn't they have been warned when they were 10% overpriced? Shouldn't they have been warned they were either 15, 20, 25? Why wait to 30% to say something? Clearly, they weren't aware of it themselves. So in terms of housing prices, the housing market, a house is only worth what a house is worth. When the last housing correction nationally started in 1989, there was a common practice of appraising the value of a house. And houses were appraised in 3 ways. My 75-year-old mother appraised houses this way. You did one which was called the replacement cost. So your house is worth what it would cost to replace today. So there's a certain price attached to the land component, and then there's a certain price attached to what it would cost to reconstruct that house. Then you have market value pricing. And what that is based on is you look at what have similar houses in the neighborhood sold for, what have similar houses in the neighborhood failed to sell for, and compared them against your house to come up with the value of the house. And that's what's called market value appraisal. And then we have what's called the investment cost. How much rent could I get out of my house if I rented it? In other words, I paid $200,000 for a house. Can I get a $2,000 a month rent for it? Which was the old standard back in the late 80s, early 90s. You wanted a 10%, standard 10% investment expectation. So those are the ways houses used to be priced at the time of the last correction, beginning in 1989. So you have to ask, why was the bank, why CMHC, why has everybody ignored that for the last 25 years? I don't know. A house is still what a house is worth. If a house burns down, how much does it cost to replace that house? And how much is that vacant lot worth? That's what that house is worth today. It isn't worth what the neighbor pays. It's worth what it costs to replace it. And that's the missing component. So when you understand that, when it comes to talking about overvaluation, it's easy. Because if a house is selling for more than it would cost to replace, then it's overpriced. If it's selling for less than it would cost to replace, then it's underpriced. There's no way that a house in Dresden, Ontario, a small community in southwestern Ontario, on a 60 by 120 foot lot that is priced at $59,000 today, right now, I can go buy that house today, and it's a beautiful little house. And there are hundreds of them in that part of the country, could be built for that money. So those houses are all underpriced. Those $1.2 million price houses that you're seeing in Toronto or Vancouver, those houses could be all built for those prices. So those homes are overpriced. Simple black and white issue.
Ross, here, just going back here for our listeners. If you're test marketing real estate advisors in Ontario, how could somebody in British Columbia or the rest of the country get a real estate advisor to help them keep their transaction costs down?
Well, right now they can go through us. We because we're not a realtor, we can offer our services across Canada. So realtors can only offer their services in their home province. We don't have those limitations. Since most of our products are created in a virtual world, in other words, we have a team of professional marketing people who had training in marketing, people who have previous experience in marketing and advertising. They prepare all of the materials for our properties. That's all virtually done. So if there was someone outside of the province that is looking for services prior to us launching an office in their neighborhood, they could go through us directly. They get a full costing out of what their package is. And for the real estate part, the part that requires a realtor, we would simply hire a realtor in their home market to facilitate that paperwork handover.
My guest has been Ross Kay, president of Ross Kay Realty Consultants. His website is rosskay.com. Coming up next, Tim Cyclesman Wood on This Week in Money.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. We're speaking with Tim Cyclesman Wood, editor of Cycles News and Views on cyclesman.com. Tim, the price of oil has been plunging rapidly, continually. What do your charts tell you about the price of crude?
Well, long term, I think crude is headed into the lower 30s at minimum, and the reason is kind of twofold. It's based on, one, the cycle, and two, some historical norms. And I guess we can talk about both of those if you'd like.
Well, let's hit the cycle, and where are we?
The cycle has to do with the CRB index. And, we talk about, in the DNA markers and all that sort of thing and setups and the statistics. And last December of 13, I published in the research letter that we had the setup, the DNA markers were in place, and that every indication was that we had seen the 3-year cycle top in the CRB, which meant commodities would go lower. And they did somewhat from that point. Then we hit a little intermediate degree cycle low, and then they kind of swung up, and it was a counter trend sort of bounce. And then in August of this last year, we had further confirmation. In other words, it just kind of, we got the setup, the DNA markers were in place, and then we got the little cycle back up into August, and it just kind of confirmed everything. Nothing changed, further solidified the deal. And then from that point, commodities started to just fall apart. So from that perspective, the cycle was set up, and here we are, and no surprise. Now, as far as where it's going, and why I'm saying that, it's mathematics. There's something that I found, a dollar ratio chart, and dollar oil ratio chart. And what it shows is that there is a relationship. You can use it to kind of extrapolate a norm or figure out what the norm has historically been, and then you look at where you're at, and then knowing the cycles with the dollar and what's going on there, and knowing what's going on with the cycle in oil, in which direction those cycles are going. When we know oil is going lower, we know the dollar's made a very, very important bottom, which we forecasted long before this breakout became obvious, as you well know. And so knowing those directions, and then knowing that this norm has to be achieved, it's only mathematics. And the mathematics simply say, based on this ratio chart, that if we return back to the norm, that oil is going into, well into the 30s or lower. And so, in a nutshell, I know that doesn't make sense without someone looking at that research, which, not to sound like a salesman here, but it's covered. I mean, it's something you got to get in front of you. It's covered in the latest research letter. But that's the reason. Math, the cycle. Cycle broke, math tells us where it's going.
And what do the historical charts say about the price of crude?
Well, the historical charts say that there is and I think you're referring to the dollar oil ratio. And what happens, for example, you have a ratio, and over the last, I forget how many days this thing is, it's like 8,000 days of data or something crazy. And the ratio has ranged from about 11.5 back in the 80s to just under 0.5 in more recent times. And the overall norm is like 3.5. Well, if you move above or below a norm long enough, then that norm no longer seems to be norm. It seems to be the normal. It's like you have a new normal. People justify things in their mind. And so what I'm saying is that when we were seeing this dollar ratio chart at the extreme norm at 0.5 or even around 1 like it has been, it felt normal because it's been there since 2005. So nearly 10 years. And so that doesn't seem like after 10 years it becomes normal, right? So you have to look at things in time. And then you find when you do that is that that's just as extreme as it was back in the 80s when it was at 11. And like I've always harped on equities, there's always a reversion to the mean, and that reversion to the mean is underway. And so again, I know that's hard to understand not looking at the data in the research letter, but it's the math behind that reversion to the mean that I'm talking about that tells us, statistically speaking, I mean, I don't know emphatically, I can't say with 100% certainty anything, but based on this math and the statistics and the cycles and the direction things seem to be going, all indications are there's going to be at least a reversion to the norm, which will put us back in the low 30s in oil. Does
the chart say anything about how long that would last?
That's a harder question. You never stay at an extreme. Well, there's never been, looking at this chart, there's never been a time where we stayed at an extreme this long. You tend to bounce above the norm and below the norm, and above the norm and below the norm. And it's like, kind of like the cat chasing its tail, or chasing a moving average, if you will. And so it's always chasing that norm. This has been an extreme for a long time. So the best answer I can give you is I don't really know. I just think that we should rebound off of this off of this extreme as we are. And it should revert to the norm, for, some extended period of time. We've never seen anything quite like this before. I would think that we will look back on the period between 05 and through 14 at that chart that I'm talking to, and the price of oil, and in due time it will look like the abnormality that it is, or that it was. So
perhaps don't get too addicted to low gasoline prices.
No, I'm not saying that at all. I'm saying actually the opposite. I'm saying this reversion to the norm means that we're resuming the old trends, if you will, or the old norms, with a higher dollar and with lower fuel prices, with lower oil prices. I'm saying those old norms are returning.
Does that mean that companies are going to have to, who are in the energy business, will have to learn to be more efficient so that they can survive on lower prices?
Well, I look at that kind of like, I would say yes. I don't know how they're going to have to manage their business, but I would say this, again, even with them and their fat profits, it's kind of like the municipalities. When times are good and the tax revenues are coming in and the housing prices were high back in 05 and 06, and the municipalities, they became dependent on the tax revenues from the property taxes and so on and so forth. And then all of a sudden, property values go down, the housing crisis comes along, the bubble burst, and then, they became, like I said, dependent on those tax revenues because it felt like a new normal. And those fat profits for the oil companies, that was not normal, that was abnormal. And I'm sure that there are companies out there that took that as a new normal, so they became dependent on it. Their budgets and so forth are dependent on those old oil prices. Whereas in fact, this is an abnormality that lasted, 9, 10 years, but it's not normal. So yeah, there's going to be a sting felt by that.
And I saw a story from a gasoline retailer saying since the prices came down, he's pumping a lot more gas. So he's actually making more money with lower prices because people are using more gasoline. They're driving more.
And that's kind of like tax revenue too. You lower taxes, it stimulates growth and so on and so forth. And in the end, you generate more tax revenue with lower taxes. Kind of the same thing.
Tim, thanks a lot for chatting with us.
Thank you.
My guest has been Tim Cyclesman Wood, editor of Cycles News and Views on cyclesman.com. Well, that wraps up our show for this week. Comments or questions for This Week in Money can be emailed to info@howstreet.com. Extended interviews can be heard on talkdigitalnetwork.com. Thanks to all of our guests, Ross Clark, Ross Kay, and Tim Cyclesman Wood. And thank you for listening. I'm Jim Goddard. We're back next week with more This Week in Money.
This Week in Money is a production of How Street Media Incorporated.